Hello and welcome to Tideline's third annual Compass series on the state of the impact investing market. I'm Jane Bieneman, Senior Advisor at Tideline. As in prior years for this event, we'll be talking about impact markets, growth and evolution. We'll talk, I'm sure, about many of the positive developments we're seeing from how more and more institutional investors are entering the market, to how we have better tools to assess performance, to other helpful trends. We'll also be talking about challenges in the market, including the macro environment and the many new rules and regulations that we are all wrestling with. I myself continue to be very excited about the momentum in the market, but also acknowledge that there are many things that could keep one awake at night. And I am so pleased to have a terrific group of experts with us today to help us understand the market better and what's happening behind the headlines. We'll start with questions from me and reserve time towards the end of our session for questions from all of you who are joining us today. So please submit any questions that you have using the Q&A feature on Zoom. And I am delighted now to introduce our panelists. Megan Riley-Caton is Senior Investment Manager at Climate Asset Management, which is a joint venture between HSBC and Pollination. Megan is responsible for impact for the firm's natural capital strategy. Rodney Foxworth is CEO and co-founder of Worthmore, a new impact advisory and direct investment firm. Previously, Rodney was CEO of Common Future, where he established both a fund of funds and a direct investment vehicle addressing the racial wealth gap. Laura Huet is partner and co-head of ESG at CMS, a UK headquartered law firm. Laura advises investors on sustainable investment strategies and regulations. Eddie Madzikanda is director at Temasek. Eddie and his team make investments across thematic areas and emerging markets globally. Dimple Sani is Managing Director, Multi-Asset Impact Investing at Anthos Fund and Asset Management. And Dimple is responsible for impact strategies across asset classes at Anthos. So welcome to you all, and let's get into our discussion. Eddie, I'd like to begin with you, if I may. A bit over 2 years ago, Temasek announced a $500 million investment in impact manager Leapfrog that made a lot of headlines and certainly got our attention at Tideline, including as perhaps indicating that the impact market was ready for institutional capital at scale. And so I'd like to ask you now, a few years into your program, what has been your experience finding opportunities in impact and building a pipeline?
Sure. Thanks for that, Jane, and hello to everybody. Thanks for joining. So Temasek, as you pointed out, is quite new to the impact space. So we only recently launched our strategy at the back end of 2020, and our initial focus there was on the social side of things, where we wanted to target the underserved. Because as we were sort of going through our strategy, we decided that this was where our focus should lie, because it was an area where not much capital was flowing. And when we were sort of looking at where the underserved were, I think what we realized that most of the underserved are all geographically located Asia, Africa, and Latin America. So this is where our sort of strategy is sort of focused. When you look within the underserved, I think what we identified were two sort of building blocks along the lines of sort of healthcare, financial inclusion, as being the two areas where we thought you could have a little bit more of a meaningful impact on lives, given the chain reaction you get when you sort of fix these two components of people's lives. I mean, better healthcare means you're able to go to work a little bit more, because I guess your healthcare is all sorted out. Financial inclusion means you can do other things like sort of insurance and whatnot, which prevents all these sort of financial shocks, which the underserved population is prone to. So we started to focus on these two sort of aspects. And when you sort of start triangulating, trying to get our interest in sort of healthcare, financial inclusion, while also looking for scale, you're looking for deep sort of impact authenticity, you quickly narrow down your lens to and also looking at emerging markets, you quickly narrow down your lens to looking at Leapfrog. So this led to this $500 million strategic partnership that you mentioned that we announced with Leapfrog at the start of 2021. Aside from Leapfrog, we've also backed a number of other managers across our focus geographies, and we've also started looking at direct deals, where we've actually invested in our first direct deal in India last year. Our experience in finding opportunities and building a pipeline has been good. We've had to change our approach slightly. The main difference between what you find between what we do within the impact strategy and other parts of Temasek is primarily around the ticket size. Temasek as an institution, we manage close to $400 billion. So typically most deals we do need to be sizable. Otherwise it just is a bit of a strain on the back end and whatnot, because all the processes are the same, whether you're doing a $10 million deal or whether you're doing a $100 million deal. But what we have found is that if you want to do impact properly, most of the sort of more authentic managers that sort of fit in with our sort of strategy are going to be more smaller regional managers, where the fund sizes is slightly smaller than we used to. So this has meant that we've had to adjust our check sizes down to accommodate some of these fund sizes, right? Because there's no way you can go write a $50 million check in a $150 million fund or $200 million fund or anything like that. So you have to sort of make sure that your commitment is in line with what the fund wants to do, because you also can't then go try push them for a bigger fund size, because that also deviates from a strategy that they've been executing on well historically. So I think that's one of the biggest sort of adjustments that we've had to make. And then we're also quite selective around sort of first-time managers, which also includes sort of existing managers that are sort of new to impact, although they've been originally operating as a manager without an impact lens, because we want to see a strong track record along the lines of financial returns, as well as on impact capabilities in practice, so that we can diligence the sort of and understand methodology and approach. For Temasek, impact intentionality is quite key. It can't just be a byproduct of the strategy. It has to be sort of the North Star. So I think this is why sort of seeing impact integrated investment decisions, post-investment tracking and reporting, targets, and other aspects like that, and also seeing the impact function also sitting within the impact investing team. So this is also quite key in terms of how we look at prospective managers. So I think all in all, when you put all these factors together, it creates quite a high bar, as we can technically not look at quite a few managers within the sort of universe of managers. But despite this, I think we've seen quite a strong pipeline, and we have deployed capital at a good pace, which is in line with our strategy. We now have coverage across all our target markets and sectors of focus. So I think we've been able to execute our strategy in line with what we were trying to do. On the direct side as well, we've been seeing a steady flow, both from our GP relationships, which have been carefully picked to be in line with our strategy, which has led to a number of sort of co-investment opportunities that we've seen from more managers. And we're also starting to see some other sort of direct deals which aren't co-investments, again, because of our focus areas and what's happening in a lot of these markets, where you're getting a lot of these sort of new innovative business models, especially in the financial inclusion space, which are catered at these underserved segments, which have been previously haven't had affordable solutions to cater to their needs. And you're seeing a lot more interesting business models which are coming up, which are catering to these people, which we're finding quite interesting. So all in all, I think we've been able to execute on our strategy, and we're continuing to deploy capital within the space.
Thank you, Eddie. It's really helpful to understand how you're approaching this market at Temasek and get those insights into how the market is evolving and still evolving, I think. Dimple, building on Eddie's comments about supply in the market, from your perspective as a multi-asset investor, I'd like to ask you what you're seeing in terms of availability of opportunities across a portfolio. So in addition to, say, in private markets, private equity, but in venture, fixed income, real assets, how we are doing in growing the supply across a portfolio.
Yeah, no, absolutely. Thanks, Jane. So as you mentioned rightly, we are a multi-asset investor, which means we look at public equities, public fixed income, real assets, which we define as both infrastructure and real estate, and we look at private debt and private equity. For us, private equity, at least in the impact portfolio, has always been focused more on venture. So actually, we don't do any mid-market or buyouts. So we're not in the TPGs and the Apollos and the KKRs. And I think that's with a healthy dose of skepticism too, by the way. And initially, when we first started impact investing, we were only looking at private markets. And what we learned over time is that if you take a total portfolio approach, one, you have a lot more flexibility in terms of how you deploy your own capital. If you have to only be dependent on the fundraising timelines and capital deployment timelines of private investors, you might be sitting on a lot of cash in what's a very volatile environment. But also for impact diversification as well. The way public companies can engage is very different from how you would engage with a private company, and the scale as well. We also thought it made sense to try and follow some of our investments from when we ideate them in the SME private side all the way up through their liquidity events. Why not keep funding them once they become public companies? So that's why for us, a total portfolio approach made a lot of sense. I think the depth of the market is still quite skewed still towards private assets, because I think a lot of people still are stuck in that first world view of, well, impact investing can only be had in authenticity in private markets. But we've chosen to really ideate and create supply on the public market side. So we didn't want to settle for the funds that already existed. And so we anchored two public equity funds. One is Global Environment Fund by 91. And the other one is Hermes, their Special Impact Opportunities Fund. And when I say anchored, I mean, we were the first investor. We co-designed their impact filters before they put in a single stock into the fund. And I think when you can co-design and co-ideate, you can create new supply, and you can do it with the authenticity that you're used to from the private markets. Given the volatility in the market, I think also having choice as an investor is really important. So now, given inflation is so high still, it's a great time to do real assets. So we're both looking at affordable housing, affordable/social housing. And we're also looking at renewable infrastructure. And that's everything from energy generation to digital infrastructure to ports and logistics. And so, you know, that helps us hedge the inflationary risk that exists in some of the other asset classes. But again, I think the impact diversification is also really important because it creates a lot of resiliency in the portfolio. So when public markets are doing well, typically the impact positions tend to outperform. But when they're not doing well, it's our private market funds that are also holding in place. And for us, it's de-risking actually the portfolio by taking this type of approach.
Thank you, Dimple. Really appreciate those insights and perspectives, including how you are helping to build the market. Like to turn to our two fund managers, starting with you, Rodney. You're a longtime leader in investing with a DEI lens. And I'm wondering what it is about the market today that's prompted you, given you the confidence to launch a new fund, a new firm. And as it relates to your strategy, I'm curious if there are implications for you and for others investing with a DEI lens from the recent U.S. Supreme Court case that banned the use of race in college admissions. We've certainly seen speculation that that ruling will affect other parts of the economy and other markets.
Yeah, thanks for including me in the conversation, Jane. Longtime admirer of Tideline and your great work, and of course, everyone that's joined in this panel. To your question, you know, to be frank, you know, DEI, while it's been an incredible part of the work that I've done historically and certainly with Worthmore, I think we look at it a bit differently, Jane, in terms of really looking at what the opportunities that we see in coming off of Dimple's comments. You know, Worthmore and in our prior work has been really focused on private markets. That's what we're focusing on. I really appreciate and we need to see more in the public market space. I really appreciate what Anthos and others are doing. So thank you for that segue, Dimple. But you know, obviously, we understand that globally, the majority of population are people of color. Here in the U.S., we're inching quite quickly to that as well. And on a macro level, we really see that there is just so much opportunity and talent that has been excluded, and we're not actually bringing in the majority of opportunity, insights, and talent into the equation you're really not going to be able to be as opportunistic and disruptive in a positive manner. And specifically as it pertains to Worthmore, the opportunity set that we see on the private market side when we're looking at venture-like, when we see these opportunities for businesses that are really focusing on the entire stakeholder set. So not just creating generational wealth for themselves and their employees and their investors, but really looking at it from a more wholesale, more holistic perspective. We really saw that there were a lot of opportunities in my prior work and leading up to the launch of Worthmore, where there are just companies that are underserved by current products and services and investment opportunities. And so we're looking at, it's interesting what Dimple, what you're pointing out in terms of like ideating and being entrepreneurial as an investor. That's something that we really is factored into the early DNA for Worthmore, because we're looking at how can we really long time partner with entrepreneurs in these businesses that, as I said, are underserved typically by traditional venture capital or private equity like vehicles. And yet that's what they're oftentimes finding themselves engaging in. And so creating an alternative opportunity set, which there are a number of folks doing this, by the way, Jane, and which I always want to remind folks, but being able to have an alternative so that particularly when we're looking at entrepreneurs of color, women, they really wanted, a lot of them really want to be long-term owners. They're not necessarily looking just for an exit. They want to create a generational company that has, again, outsized impact across all stakeholders. And so really being able to create a long-term partnership, that's something that we're really focused with on Worthmore. So having capital that is really partnership capital, and really being able to bring in not just the financial components of that, but obviously social and intellectual capital as well. To your question about what's happening in the U.S. in terms of SCOTUS, obviously this connects right into the battlefield as it is with ESG and the response to ESG. Obviously DEI, it fits right into the S and ESG. You know, there's a number of ways of looking at it, Jane. To be frank, as we know, there's you know, people of color, fund managers of color, capital innovators of color have already been underserved for so long, underinvested in to begin with. And so even though we've had some progress, I think there's a lot of indicators over the last few, 18 months or so that there's been some backsliding as well, right? In terms of investment into these majority people of color enterprises and such. And so for a number of my peers, it's sort of business as usual. You know, how do we just continue to move forward? And at the same time, I think there's a real statement from a sort of political perspective that if you just take not only the SCOTUS decision on affirmative action, but quite frankly, many decisions, if you're looking at that S and ESG as it pertains to race, gender, sexual orientation, sexual identity, those are areas that we're seeing a lot of pushback on broadly. So not just in colleges, but like also obviously in hiring. That's something that a lot of attorney generals are already starting to look into and see how that has negative implications with the ruling. And so, as I said, with the entrepreneurial kind of spirit, and so many of us who are doing this work, it's sort of business as usual, unfortunately. But finding real opportunities and really making a statement and really ensuring that this is DEI as it's consistently sort of, framed. Yes, there's a clear moral component to this, and I don't shy away from that at all. But there's a real economic case here as well, and you're really going to sideline as much opportunity and talent. The vast majority of folks, by not investing in them, it's a non-economic sort of, it's a non-sensible economic strategy, right? And so I would just say again, one of the pieces for us at Worthmore is ensuring that all stakeholders actually have a means of being at the table and creating an alternative set there. Possibility for entrepreneurs in these companies. And so that's really where we're seeing a real opportunity, Jane, is to be able to expand there.
Mm-hmm. Thank you, Rodney. Really appreciate your candor and elevating these issues. Megan, you are also launching a new effort at Climate Asset Management. And would you tell us about your approach to getting a natural capital strategy off the ground and what's been important to your success particularly in a thematic area that I think is a little less well understood broadly in the market.
Of course. Thank you for having me. Pleasure to be here. You explained Climate Asset Management. We're a joint venture between HSBC and Pollination, which is a climate advisory and investment firm. And we are dedicated solely to natural capital. Our mission is bringing large scale institutional capital into nature restoration. So really putting nature on the balance sheet. And I think from that perspective, we are, particularly in our natural capital strategy, seeking to deliver scale, commercial returns, and meaningful outcomes for climate, nature, and community. And one of the interesting aspects of that journey has been the perception of potential conflict between returns and impact. Mm-hmm. So if you're doing this impact work, it's got to be a drag on the returns. If you're trying to make money, you must not be serious about impact, right? And I think those challenges are probably shared by many in this space since the beginning. The way that we have addressed that, I think is very appropriate for natural capital, which is a long-term real assets asset class. So to Dimple's point about infrastructure and renewable energy, this is critical infrastructure that belongs on your balance sheet alongside those two categories. And when your focus, historically, nature has been managed in a way to maximize short-term exploitation for economic gain through maximum productivity. And we understand why that is the case. But when your focus is long-term enough, particularly in this era of increasing weather volatility and other shocks, our thesis is quite clear that you can manage these assets in a way that delivers better, more resilient commercial returns and better long-term outcomes. And so it's really aligned. Our returns and our impact thesis are aligned. And I think that's core to the authenticity of what we bring to the table, and also really exciting. Impact is not a bolt-on we're doing afterwards. It's core to our thesis because we are really seeking to demonstrate you can do this at scale. I think some of our challenges in terms of scale, similar to what Eddie articulated, it's hard for us to write small checks and for all the reasons that you can imagine. Natural capital is by definition quite bespoke. It's can be challenged. It's different to invest in an almond farm in Spain or a forest in the United States, right? Those are different underlying trends, but I think they're riding a lot of the same macro trends. And what we've done is put together a strategy that combines multiple different exposure to multiple different geographies, multiple different parts of natural capital across agriculture, forestry, payments for ecosystem services markets like carbon, that allows investors to get access to that diversification and again, to write a larger check to us so that we can then deploy. In terms of what's been challenging about a new thematic area, well, it's new. When we do our decks, there's a section on what is natural capital, what does it mean, why is it a good asset class for this economic environment, given the inflation correlation, for example. And I think that just requires some investor education. But we've found, for example, most of our investors are based in the EU. From a geographical perspective, we found that European investors are quite motivated on the topic of nature. There's actually a requirement under French law that all financial institutions disclose their risks and dependencies on nature. And that's something they're figuring out how to do. We expect that may come from a voluntary perspective through the Task Force on Nature-Related Financial Disclosures. So there's a lot more momentum on the nature side, on that side of the pond, than I would say there is in the US, and that has been core to our success. As has within the natural capital strategy, we are an Article 9 dark green fund under the EU SFDR, which Laura knows a lot more about than I do. So I won't say more about it, but that has also been key to our allocation, to our success, in that a lot of our investors have Article 9 allocation. It means we've chosen to be regulated as a sustainable product. And I can speak more as to how specifically we've done that. And then from a geographical perspective, in terms of opportunities, again, we've designed a globally diversified strategy, which allows us to deploy across multiple geographies. And perhaps the wonderful thing about nature and nature restoration is that we need it everywhere. We need it in cities. We need it on every continent. And there's so much opportunity. It can be done actually at much lower cost in many cases than delivering climate objectives, but it can also be done together with delivering really important objectives for climate and community. I think the challenge there is, again, because of the way we valued nature in the past, we need to be developing alternative markets, payments for ecosystem services markets that value the services that nature provides that we have not been paying for to date, and I think with some reasonable consequences. And so a lot of our allocation strategy also is focused on those markets that are starting to emerge, and where we can ride those trends and really demonstrate that commercial capital belongs in this space, and that these types of investments belong on the balance sheet.
Thank you, Megan. And one of the things you brought up is regulation, which is a good segue to a question I have for Laura. Laura, I think it's fair to say regulations are top of mind for investors everywhere. Are in your experience, are all of these regulations helping managers navigate impact? Are they providing some clarity and transparency, or are they creating confusion about what an impact investment is and how to position a product and actually stymieing growth in the market and new product? So love to hear your perspectives on those issues.
Thanks, Jane. And hi, everybody. Really great to be here. And apologies to be the one that gets introduced with the regulatory question when everybody's got such wonderful things to talk about from a practical perspective. But hopefully I can bring some light on those things. SFDR, the EU taxonomy, all of the current regulations that we are seeing, are they helpful for the impact market? No. They are not about impact, they are about disclosure. And the way that they have been implemented has left enormous scope for application, for interpretation, and for the way that different houses consider what impact is. It just doesn't factor into it with SFDR. And one of the really important things that Megan pulled out in terms of natural capital and the sustainable investments and how it's an Article 9 fund, so has a sustainable investment objective and is doing all of these great things and is impact, is not necessarily the case. Now, many of those of you on the call may also be aware of, institutional investors' allocation priorities in Europe towards Article 8 or Article 9 funds under SFDR. But from an impact perspective, although many people, and I hear it all the time, we want to be Article 9, we want to be the greenest of the green, really dark green, that has to be Article 9. It's not necessarily the case if you are looking for a pure impact strategy. Because where I have seen, and Jane, you've heard me say this many times, I'm sure, where I've seen the most impactful strategies is where change is being made, where there is real meaningful, I was making notes on what everybody was saying, that real intentionality to change and the meaningful outcomes that Megan referred to, that's what we need. And so we don't necessarily start with a dark green fund. We are looking to make those changes and be able to demonstrate those changes over the course of a long-term investment. And that's not what the regulations are doing. The regulations are saying, tell us what you're doing and how you're doing it and show us your numbers. That's what the regulations are trying to do at the moment. Now, the issue with that is that they have been interpreted in a very, very different way. And so what we're going to see over the course of the next few months is a consultation proposed to change SFDR. Now that we've all just got settled into it, it has been very, very difficult in its construction and in its application. And now we are looking to see change. Because if I ask any two different houses that I act for, and to refer to what the other panelists said, again, I was taking notes, we've covered Rodney, you covered DEI, Dimple, you were talking about the difference between public and private markets, we've heard about the natural capital. These all have very different strategies, all have very different metrics, all have very different ways of being implemented for those long-term outcomes. And at the moment, we don't have anything around that. We don't have anything to talk about. Well, if you're looking for impact in this sector, it's going to be a very different measure to impact in that sector. And what does it mean? And when you bring in the different jurisdictions, even within Europe, there's a huge amount of disparity. Megan again referred to the French law in terms of the impact on nature. There are different laws everywhere. There are new laws changing all the time. The regulators, it's very politicized. different countries want to be seen to be the best. So it is not bringing clarity at all. Where we need clarity is from the houses, from the investment managers, to explain what they are doing and to explain how they are doing it. Be aware of the regulations, keep on top of the regulations, but that impact is not being driven by the regulations. It's being driven by the really great work that's being done by, you know, those of us on the call, and the wider industry that's really focused on this.
Thank you, Laura. I guess that sort of golden egg of getting to transparency and clarity is not going to come purely from regulation, but appreciate those thoughts. Dimple, like to come back to you and build. We heard a little bit from Megan about the connection between impact and financial performance, and I think others as well. I'd like to ask you about how you think about the relationship between financial and impact performance, and are you seeing that sustainability drives financial performance? And if so, where do you see that coming from?
Yeah, so it's interesting. Again, when we first started our journey, we were what I would say impact first. So we were willing to take even the slightest concession to be able to do highly impactful deals. And what we realized over time is twofold. One is that when we were doing impact first deals, some of the returns that we had weren't actually covering the cost of running our fund. So there was a transactional cost. And we were only enabling subscale funds, really hard strategies with really tough theory of changes and frontier markets that weren't really viable in the end. And secondly, we realized that some of the funds that we seeded actually had commercial returns. So we had pattern recognition that was starting to develop. So today we weigh equally impact and commercial returns. So we actually don't think that you have to make any concessions at all. And that applies to all of the asset classes that we invest in. And that's evidenced in how we do our DD. So when we look at a deal, we make sure it meets our financial risk return, and we've created a financial efficient frontier. That's a little technical, but because we have a multi-asset model, we create a strategic asset allocation that tells us how to build the portfolio asset class by asset class. And so the way you build it, optimizing for risk return, it's called an efficient frontier. We are also in the process of modeling an impact efficient frontier, which means we know at any given time, what is the right impact risk return amongst themes that we're looking at. And we try and superimpose those. So that's how we weigh them equally. And then we try and invest right along or as close to those efficient frontiers as possible. And the question you had about sustainable alpha or impact alpha and how that's manifesting itself. Well, I think our returns speak for itself. So I'll say in some of the most challenging years during COVID, 2020, 2021, and sort of the tail end of 2022, our impact portfolio really held in place. And as I mentioned in 2020, when the public markets were up, our impact public equity strategies actually outperformed what was already an incredible market. So it's a small, subset of funds, and it's, a 2 or 3 year time horizon since we've been doing public markets. But over time, I think what we've realized is if you look at viable funds with strong theory of changes, and you're really clear about your intention to look for commercial returns, you're looking for things that are just much more viable in the long term and built for resiliency. And so from a common sense point of view, it makes sense that the companies that you're investing in, whether they're private SMEs or large cap companies, or even real assets, they're going to, withstand these cycles around pandemics and geopolitical risk and climate change, because you're building them for that resiliency. So long-term, we do expect an impact or sustainable alpha. And for now, it also protects us on the downside as well.
Thank you, Dimple. Notwithstanding, there is a great need for some concessionary capital. It is
100%,
very hard to dissuade the mainstream market that there is not an inherent trade-off of financial return for impact. So I really appreciate your comments and others to help to support that there is not an inherent trade-off. Megan, that's a segue coming back to you on impact performance, which you did mention earlier, but if you could give us a little bit more of a sense of how you will be accountable at Climate Asset Management for impact performance and what the LPs you're talking to expect.
Of course. Well, I mentioned Article 9. That is what our LPs want from us currently. Predominantly, that's what they have allocation for. And to Laura's point, it is a reporting obligation for us at the moment. It is obviously core to our investment strategy in the sense that we need to be confident that what we invest in aligns with the EU taxonomy and contributes to these objectives. And one of the interesting aspects of that for us is that a majority, at least in the natural capital strategy of our investments, will be into the agriculture space, and agriculture is not yet scoped into the EU taxonomy. So I think that's just one example of how challenging it is to commit to follow regulation that is being written. It evolves regularly. A couple of weeks ago, it was announced that if you are investing in projects that do biodiversity enhancement for which the return is some type of offset, so that would cover the mitigation banking industry in the United States, which is the largest and most established biodiversity market in the world, you cannot claim a substantial contribution to biodiversity enhancement. And the logic makes sense, right? Because you're offsetting a negative impact somewhere else. It does take the largest biodiversity market off the table from being able to declare that alignment. That doesn't mean you can't have alignment with another sustainability objective, but I think that just illustrates the point of how challenging it is to build a strategy and follow those requirements at the same time. So we do spend a lot of time on that in terms of serving our investors' needs and making sure that we'll be able to comply with our commitments. But we also, exactly to Laura's point, Article 9 doesn't tell us how to generate impact. Impact is core to our strategy. We built it from the beginning, and we needed, for us, impact objectives that clearly articulate what we're going to deliver on the climate, nature, and community front, just like we articulate what we're going to deliver on the financial front, right? What we hope to deliver. So what we did is we sat down, we actually used the tools that I'm sure everyone on this call is familiar with to develop our theory of change and articulate what it is we're trying to achieve. And we boiled it down to 12 impact objectives across 4 categories: biodiversity, climate, water, and community. 8 of those are quantitative. Those objectives are aligned with the Global Biodiversity Framework. They're aligned with EU biodiversity strategy, and they're also aligned with other global and particularly EU goals. And that's important for us because we are delivering blended impact across those 4 categories I described, as well as obviously a blended financial impact for the Natural Capital Fund. And it's really important to us to demonstrate how each asset will contribute in a substantial way to multiple impact objectives. We cannot expect everyone to contribute to all of them. So we developed our own framework, and it's very important to us that the work that we do has integrity, has intentionality. We're underwriting this from the beginning. And so we will hold ourselves accountable. I think 2 interesting aspects of this when you're focusing on biodiversity. Many of the biodiversity objectives that we may seek to achieve depend on how the natural world responds to human intervention. And that is not always within human capacity to control or predict. So you can imagine a situation where you're trying to create habitat for a certain species to return. You may do everything right, but that species may not return. And that may be because of something that happened off your property. That may be because of climate change, all sorts of reasons. And so we've adopted an adaptive management approach, which will be familiar to folks who've worked in biodiversity before, in terms of, we're going to try this, we're going to set our ambition high, and if it doesn't work, we're going to try something else. So that's built into our impact framework. I think another challenge that we have in terms of our impact framework is, again, setting our ambition high with regard to things like reducing chemical inputs in agriculture. A lot of the data just does not exist to enable benchmarking. It just doesn't, particularly in some of the specialty crops that we participate in. So we're very confident in our approach and that we can deliver it, but will we be able to point to a global data set and demonstrate that we outperformed it? We don't exactly know, because we expect that data to be collected and reported in more detail over the life of this fund. And we do have 15 years for those markets to evolve. So I think those are 2 aspects of our impact framework where, again, we've tried to set our ambition high and hold ourselves accountable, and also be really transparent about what we can control and what we cannot. We've set our objectives specific to the land under our management, while recognizing there are other off-site and value chain improvements we will make as well, that we will report on, but are harder to measure. I wanted to make one quick point on biodiversity measurement. I think there's a perception in the market that biodiversity is hard to measure and not fungible. It is correct, it is not fungible. Very hard to trade off enhancing a bird population in the Pacific Northwest for improving the microbiology of soil in Australia. I completely agree. Those two things should not be on the same table. That said, we can measure biodiversity enhancement. You can send a scientist out to the field and ask them what it looks like today, what can be done to improve it, and how to get there. We know how to do this. And so just as there's a sense of urgency in the climate space for folks working, for example, in the voluntary carbon market, saying it's not perfect, but we don't have time to wait. On biodiversity loss, we also don't have time to wait. We do know how to do this. And I recognize that we are in a privileged position because we make direct investments in nature. So we have a huge amount of, to the extent we have control, we have a lot of it, and we have a lot of data. And that's very, very different for someone who's deploying in a public equity strategy. But I'm very hopeful that the Task Force on Nature-Related Financial Disclosures, as I mentioned, which we're doing a pilot on, and a number of other areas, will help to illuminate that for investors. And then the final bit of our impact framework that we will report on, and that will hold ourselves accountable to is a commitment to advancing the field. We feel strongly that we're the first large-scale natural capital fund. We do not intend to be the last, and that will happen because we're able to move the field forward. So with every investment that we make, we ensure that we are doing something to do that. And that could be deploying a new technology for monitoring, reporting, and verification. It could be demonstrating a new financial structure to deliver land back to communities. There are a variety of different ways we can do that, but we intend to be able to demonstrate that those improvements and that innovation for the field as a whole.
Thank you, Megan. Laura, I'd like to turn back to you with apologies, another thorny question. Would you comment, please, on what you are seeing as the effects of the backlash against ESG, particularly in the US, how that is affecting demand for sustainable investments?
Yeah, absolutely. I could listen to Megan speaking on her work all day, and I've got quite a few things that I'd like to tie in from what she said, which is also linked to the question, Jane. But for sure, I mean, I think when you've got a BlackRock who are in Europe really setting their stall out, really being leaders in this space, seeking to be leaders in this space, but then being divested by, and I've got the list here, Arkansas, Utah, Texas, Florida, Louisiana, Missouri, Arizona, North Carolina, West Virginia. Let's have a thought about what they've all got in common. It makes for a very difficult global strategy to be able to pursue. I have very large investment managers that I look after who say, well, we just can't go to these states anymore. We've made the decision that we just can't do it because we can't hold our heads up in terms of all of the other global investments that we're making when we are being forced by particular areas to not follow the standards that we have very publicly set for ourselves and what we're doing. And I think we've seen the backlash as well. I'm not sure how realistic the numbers are and what the numbers actually mean. I mean, we've seen figures about ESG focused funds falling for the first time since 2011. But then if you look at the non-ESG focused funds, whatever those terms mean and however that's being measured over the course of the last year have also fallen by trillions. So there has just been an overall change in the investment landscape over the course of the last year for many, many, many reasons. And it's not necessarily ESG driven, but certainly I think one of the issues with the backlash in the US, and as a real sort of more left-wing European, it makes my mind kind of bleed slightly when, I hear the politicians talk about how this isn't long-term and you can't take in non-financial considerations into these investments. It gives me goosebumps because of course, if you are looking long term in any of these investments, it is just another criteria like credit risk or anything else that you want to consider. It is another risk perspective that may very well and is very likely to have over the long term a financial implication. So it just blows my mind that it's considered still in many areas as not, but let's find something to politicize and we'll politicize it for whatever reasons that we want to. But I think when you then expand that out in terms of perhaps what LPs are looking for and where that gets to us in, do we feel that there's kind of an integrity in the market? It comes back to a lot of the things that Megan said that I really, really applaud in terms of the ambition. We want to see ambition. The lawmakers, particularly, in Europe, they are looking for ambition. They are looking for accountability. They are looking for houses to put their hands up and say, we're trying really, really hard. This is what we're trying to do. And this is where we're not quite there yet. This is where we have gaps. And this is what we're working on. And for me, that's what I really want to see my clients do. Focus on what they are doing and focus on what they're not doing and what they are looking to try to fix over the course of time. And I think being open and honest and transparent on both of those will really help with the idea of integrity in the market and help to push all of these issues forward. I think one of the things, just to wrap up on that the word that we haven't said, although we've all kind of talked about it, it's not just intentionality, but additionality. And that's the difference with the impact market, as opposed to LPs saying, we want a strategy that focuses on sustainable investments. Well, that's super, but that's not necessarily going to be impact. What is it that we are looking to achieve? And where you have in the private market sector, where across any sector, but within private markets, much more control in terms of the investments that you are making, it should be much more straightforward to show that. But to go back to the points that have been made, and particularly by Dimple, it's very important also to be able to show this in the public market side. And that's where it is very, very hard. And I've already had conversations with regulators saying, with the public markets fund, how can you really explain to me the additionality that this fund is having when it is invested across all of these different publicly listed equities? What would have been different if the fund had not existed? Where is that change being shown? And so there will continue on the impact in the impact market to be a real differentiation across public and private. I realize I've gotten away from the backlash question, but I think it gets to the point that there is a much, much wider piece to think about and much bigger problems to consider. And to wrap up with the backlash point, where there is such a differentiation across the globe on what are essentially global issues, where US investors or US funds can't measure up or can't follow through with the EU regulations that are hitting them because that's where they're shown, because of the rules there and the rules there, it's just not going to work for anyone. So we need a kind of coming together. We need it to be considered on a more global basis, however that is done. And the continued backlash in the US is not helping, because with such a huge market, falling behind in that area becomes very, very hard.
Thank you, Laura. I could listen to all of you talk forever. I'd like to turn to Eddie now, please, and ask you at Temasek what you're looking for in an impact investment, how managers can differentiate themselves. And if I could, we've gotten a couple questions about a comment Dimple made earlier about some skepticism towards large platforms. So I would be curious if you could comment as well on your perspective on that, how you think about that at Temasek as well.
Sure. I'll try to keep this brief. So because we are behind time, but from an impact perspective, I think the way we look at it, I think we want to see sort of clear intentionality behind the strategy, right? Impact has to be sort of entrenched in the DNA of the firm and core to everything that they do. As sort of Laura was talking about earlier, I think just you saying I'm article this or that, or I'm using such and such a metric, it doesn't really define what you are far, because I think what you find is it then essentially just becomes a box ticking type of exercise if it's not part of the DNA of what you're trying to do. And I think I think for us, this is not something that we like to sort of dabble in, because I think what you find is in a lot of these sort of managers who just say, yeah, I'm XYZ, this is my label, so to speak. Once you start sort of peeling the onion, I think you realize that there's not much substance behind it, and it's really just a box ticking type of thing that they've been doing, so that they can go and target certain types of LPs or whatever who would only ever back a manager who has such and such a label. So I think that's what we found in some of the work that we've been doing. What we typically find, sort of when you're speaking to a good, really intentionality focused impact fund, is when you speak to anybody within the organization, not just the impact person. It could be a junior analyst or associate within the team. They can clearly articulate the impact methodology and focus areas and strategy. And for us, this is quite a big differentiator as you sort of look at different managers, because you can clearly see who is really a true impact manager as opposed to somebody who's just sort of using the label and just sort of box ticking to make do and access a broader set of a broader LP base, because they now have such and such a label which allows them to access capital from another bucket which wasn't previously accessible to them. I haven't seen the question, so I didn't get the question you're talking about in terms of big platforms.
And Dimple, you may want to jump in as well, but I think the question is to elaborate on the skepticism for Dimple to elaborate on the skepticism.
Oh, on Dimple, okay.
Mentioned towards large platforms, and yeah, I was wondering if that's a shared skepticism at Temasek.
Yeah, not really. I think for us, it's everything differs, right? I think we can't sort of just paint everything with one broad brush. I think it's all sort of particular to all the different situations.
Appreciate that. Okay, well, let me. I have one more question for Rodney, and we'll see if we have time for any more audience questions. But Rodney, wanted to ask you what you alluded to earlier about the permanent capital element of Worthmore and how that relates to your impact outcomes. And we did get a question from the audience, how you generate returns without company exits. So interested in your non-extractive approach to exits.
Or at least extractive approach right now. Wow, what a fantastic conversation. So I'm gonna try to hit this as precisely as possible. But one, I did want to acknowledge something that Dimple said earlier in the conversation, because it's likely that, you know, as much as strong of ambition that we have at Worthmore, it's likely that we might be a suboptimal, subscale type entity, and for a couple of reasons. One of which pertains to the fact of, where is the market and commitment from asset owners from the longer term view? And so when we're thinking about permanent capital, one of the things that this is much more challenging from a business model perspective, right? And from the economics of it, but there are a number of means of providing liquidity to investors that does not require a company exit in the traditional sense. Redeemable equity, a form of profit sharing. There are ways of structuring individual opportunities and investments in such a way that are much more reflective of the specific opportunity. And so I think this is one of the things that actually, this is a much more complicated and nuanced way of going about doing the work. Having said that, the other piece of it is, we're thinking about, I know there was a question around concessionary as well. You know, at Common Future, I used to say, it's not about that. It's about, what are you talking about? Community adjusted returns. And for Worthmore, it's more about stakeholder adjusted. And by this point, looking at ways in which we can ensure that employees, workers, impacted communities actually have an opportunity to share in the gains, the economic gains. And so there is a piece there in terms of, how do we structure these different types of models that are not the, 3 to 7 year exit profile, 10-year even profile. We're looking at the 2 and 20 model. All of those things are up for reconfiguration. And so I just wanted to point just to name that explicitly, Jane, that it's really looking at it from an investment perspective at the company level that makes it even more nuanced and complicated. And to that point, and to Dimple's earlier comment, I don't see that as a negative thing that we might achieve like subscale, right? It's actually hopefully the market transitions such that there is more capital that will allow for scalability in the long term.
Thank you, Rodney. I think in our last couple of minutes, I'd like to do a quick round robin and ask each of you a final question, which is what advice do you have for those who are with us today about their own impact investing strategy, whether they're starting or growing a program? And perhaps Laura, Megan, and Rodney, you could speak to asset managers, and Dimple and Eddie, thinking about what you would say to other asset allocators about the opportunities or challenges in impact investing. So Laura, if we could start with you, that would be great.
Oh, so much. I think, be to the point that I made before, be driven by your own thesis on this, be driven by your own strategies and focus and the impact that you want to make, not by the regulation. That might sound odd coming from the lawyer who wants to implement this for you. However, we need to make that fit you, not the other way around. So really focus on the change that you want to be making.
That resonates so much, that strategy drives structure and everything else. Thank you. Megan, we'll turn it to you.
This is maybe too on brand, but put nature as part of the conversation. No matter what we do, we need to address biodiversity loss. That is actually potentially a larger existential threat to the future of humanity than climate change, and that's saying a lot. And they're interlinked. And I think there's a perception that biodiversity is, like I said, hard to manage, remote, challenging to bring institutional capital in, challenging to talk about. There's a lot of historical legacy of the conservation movement, excluding traditional communities, which I think is challenging from a DEI perspective. There's a lot there, and it's complex and it's nuanced, but it is core. So my request, I suppose, or hopefully inspiration, is that it's actually core to everything we do. We need oxygen to be able to generate returns. So think about it, and don't be dissuaded by the challenges of MRV and that kind of thing. And if people want to talk about metrics, please feel free always to reach out to me.
Thank you, Megan. Rodney, over to you.
Yeah, thanks for that, Megan, because to me, it's actually how we're looking at reconfiguring the economics and business models for all the work that we actually do for most of us on this panel. Because to your point, I mean, we know all the evidence. We are experiencing the fact that there's so much shifts in the climate that's not helpful for humanity, and there's still questions of, what type of return can we get in this process, right? And not ignoring the fact that, hey, are we going to be able to live? Are we going to be able to breathe, right? There's more evidence and more compounding evidence of the decrease in net worth, for example, in this U.S. among Black households, which in minority households, which are increasing, not the minority, by the way, the majority. And so what does that actually mean from a future perspective if you don't even have the wealth in a country to actually continue to do some of the things that investors are looking for? So just the general remodeling and reconfiguration.
Thank you. Dimple, over to you.
Yeah, really briefly, I think there's a lot of people that are sitting on the sidelines and sitting in cash in terms of asset allocators, because they're really perplexed by what's happening and afraid to make a move. So I would say, one, think of allocating to impact strategies as risk mitigation. It's actually going to outperform and be a little bit more resilient in the long term. And then again, if you take a total portfolio approach, you don't have to be limited to, the highest risk asset classes. You can try and have your pick. And that creates more movement and agility and velocity in the market, but also helps you as an investor stay agile.
Great advice. And Eddie, to you.
Yeah, I think just from my side, I just wanted to reiterate that impact as well as financial returns can go hand in hand. I don't think it's one or the other. So just stay the course and just find out where you want to sort of focus within the space and get going.
Thank you. Well, we are at time. A very big thanks to our panelists. You're all inspiring and doing important work. Keep it up, and thank you for your time today. And thank you very much for everyone who joined us. We really appreciate your time, interest, and questions as well. Thank you.